if in fact this is that final leg, that's what I expect to see the balance of this month. Probably, I'm using the time frame as a, just a guess that it's kind of between now and the election. You're going to see most of the ground covered, if not all of it. Possibly it goes beyond that. I don't want people thinking that I have some crystal ball that can say, precisely when it's going to end, because I don't. But I think it's going to be steep. I think it's going to be you're going to see a lot of stocks. It's going to be steep and broad, so you're going to see it play out in a lot of stocks, not just a few. I don't want to skate over the Russell, because I really believe that's a huge move. If we go from where we are now to 3,300, you're talking about a huge move in a similar time frame to the S&P. So it had that run. It was up 10% in that quick week where everybody was bearish on the Russell and saying, I heard it over and over. Why are you calling for a big run in the Russell? It looks terrible. It's not performing. It's the Russell. The small caps aren't going anywhere. I heard that over and over, and then all of a sudden, because you had gotten to that level of sentiment, it busted out and had a big vertical move in a week. And what we've done is given most of that back in this last week's sell-off. So the same people who got kind of excited with a 10% run in the Russell are right back on the bear side, or skeptical and saying, well, I guess that was just a false breakout. But I do think what we did, the Russell's come back to the 200-day moving average. It's done really no damage. It just kind of filled in from that huge run. It was a huge few-day run. So I think, I'm very comfortable with my 3,300, which is a huge move from here. I do think when I say it's going to be broader, it's going to be a lot broader. It's not the Magnificent Seven, although the techs will play. I have a target on. I don't want to jump ahead of you, but I have a target on SMH, the semiconductor ETF, of 400 now. So it got down to basically 200. It's a double, and if it happens in a double in 3, 4, 5 months, is an unbelievable move. And a lot of people are saying the semi move's over, or semis are they had their day. I don't think so. So this is going to be both the leadership that kind of got us here, and then the new leadership of small caps and cyclicals. And like I said, it's going to be, I think, unusually, everybody was pointing to the narrow market. Now we're going to see that the market is actually broadening into a top. More typical would be a narrowing into a top. But I think what's going to run here, the narratives are going to get you there, is going to be, yes, the tightening cycle is over. The Fed is easing. That the fear of a hard landing was premature. That we're having a soft landing, and that basically the Fed's going to engineer a new, a liftoff into a new cycle, basically, or it'll feel like a new cycle in terms of a lot of the early cycle things that have been out of favor are going to play again, cyclicals, et cetera. So you're going to have kind of the old stuff still playing and new stuff getting on board. Now, to get to your question, there's always something that I can always be wrong. I speak with conviction because that's what my work gives me when I see what I see, and if I have conviction, I'm going to speak with it. But that doesn't mean that I'm going to be right, or that I know this is going to happen, because I don't. So can something come in here, so-called black swan, or something come in here to disrupt things, election-wise, or just like we saw with the carry trade, but much bigger? Could we have an event geopolitically, World War III, or a huge Middle East blow up with Iran entering the fray and us having to go in there? Could any of that happen? Certainly, it's there's always a possibility of something like that. I will say, typically, if history is a guide, oftentimes wars are the beginning of upside, not the end of a market. So I learned that a hard lesson back in the early 1990s when we had Gulf War One. When we entered Iraq, and to defend Kuwait. I thought, oh, this is going to give us a buying opportunity down the road. We're going to get hit here. And you had a couple of days where it was, volatile to the downside, if I recall right, and then it was off to the races. So I think people have to be careful. Don't just assume. Obviously, a world war is a different story, but don't just assume that when there's geopolitical tensions around the world and that look like they're going to escalate, that's necessarily going to turn the market lower. It doesn't necessarily. But are there things that could crop up? Yeah, but I will tell you, of the things I can analyze and the things that I see in the market right now, there's nothing that I see to suggest a bear market. What I see is very bullish. And I do, as I say, I use fundamentals, I use technicals, I use obviously I think my macro is as good as anybody. I use my macro analysis. I use sentiment. I'm a contrarian for sure, and then I use cross market analysis, and which really helps give me the conviction when I see those things underneath the surface that are confirming what I see in the averages. And right now, I just see a lot of bullish things. Now, I don't know what's going to happen the next day or next week, but this is, it's not a long time out. I'm not saying, I get accused of being a broken clock because the cycle extends, but I'm not saying it's going to take 2 years or that I don't, it could be 3 months or 2 years. No, I'm saying, it's 3, 4, 5 months is what I would expect. Could something come in like the pandemic did to stretch it out? Sure. But right now, all my analysis points to this being a parabolic coming up, and that will, I think it'll be the biggest rally we've seen in our lifetimes. You may even be in recession now. When we go back, the National Bureau of Economic Research is responsible for dating recessions. They do it after the fact. When they go back after we're out of recession and look back, I will not be surprised if they are able, their work dates the recession to, let's say, June or July of this year. So we may already be in recession. We may not be, but we may be. Certainly, sectors of the economy are in recession. Parts of the consumer, the lower end of the consumer population are in recession or are feeling like they're in recession. So, and they're using jobs as their other measure of, one's the economy, one's inflation. Unfortunately, jobs are a lagging indicator. So if you're using, a monthly jobs number or even the weekly numbers, if you're using all the, jobs data to determine when to time, you're even farther behind the curve because it's a lagging indicator. It's not even a coincident indicator. So, I think the stock market is probably your best leading indicator, and they don't want to use that at all. Unlike other Feds, I mean, the problem we have with Feds in general, but this one in particular, I don't know that there's anybody on that Fed, in fact, on the FOMC committee, in fact, I'm pretty sure there isn't, with market experience. There's nobody that understands markets in terms of their ability to forecast the future. Now, of course, the markets lots of times misjudge things and they forecast something that doesn't happen. So that I'm not saying it's a perfect indicator, but in the aggregate markets, both bond and stock are leading indicators of what's to come. Bond market's a better forecaster than any member of the FOMC. I guarantee you that, because it's a law of large numbers. You've got a lot of people acting on what they see and what they believe, and taking that large number and discounting it into a market is you got a much better chance of that being pretty good predictor of what's coming. So the fact that the bond market's dropped rates 100 basis points is telling you that when they look at all their work, and everybody does it differently, but when they look at all their work, when economists look at it, when market participants look at it, informed participants, they're coming to the conclusion that inflation's lower and heading lower, is down and heading lower, and and they're also probably this last 100 basis point move has as much to do with they're seeing all the early signs of an economy that's decelerating and soon to decelerate faster. The Fed unfortunately isn't there yet. They're beginning to get there. They understand the economy's decelerating. I don't think they understand the degree to it, and that's being weighed against. We don't want to make a mistake again and be, and let inflation break out. So all those things play into a committee. And again, committees can see camels out of horses, or whatever, predict camels out of horses. So, committees, particularly committees that are designed to be consensus, can be slow to react and more careful and all of that. So this isn't new. We've seen this every cycle. The Fed is usually behind the curve and then has to rush to catch up. I don't know that this is, I can't say this is absolute. I'm not counting on it to get the melt up. A lot of other things are pointing to the melt up, but I wouldn't be surprised if between now and the election or now and the end of the year, the Fed's in catch-up mode. And that once they're in catch-up mode, that's a wind at your back as an investor. That will drive the market. So you might then see another, cut the next month, or certainly early November when they meet again, and another cut, and the cuts may get bigger. If they're behind the curve and they start recognizing they're behind the curve, they're not going to be doing quarter point cuts. So all of that may play in. I have no idea. But what I can have a pretty good idea on is that the bond market will be ahead of them. So if we got down to, I think we got down to 370, maybe even the 360s this past week, and now we've backed up to 4% on the 10-year. I'm predicting we'll see 2.5 during the melt up. So between now and let's say the election, I think you probably will see 2.5. So it doesn't really matter what the Fed, what rate the Fed chooses to move to. It'll be an add-on if they get more aggressive, but it doesn't matter that much.